The UK retail graveyard is enormous. Household names, high street giants, once dominant chains, all gone. Woolworths, BHS, Debenhams, Wilko. Each collapse followed a familiar script: falling footfall, rising rents, crushing debt, and yet, through every retail apocalypse, one name keeps quietly surviving. Not flashy, not trendy, not loud. Spar. While supermarkets collapse under billions in debt, Spar stores continue trading. While retailers close thousands of locations, Spar quietly opens new ones. While others beg landlords and banks for mercy, Spar barely makes headlines. This raises a dangerous question. Why does Spar survive when almost everyone else fails? Is it luck? Is it timing? Or is Spar built differently from the ground up? Because if you want to understand retail bankruptcy, you need to study the companies that never go bankrupt. And Spar might be the most underestimated survivor in British retail history. But here is where it gets interesting. Spar is not immune to failure. It operates in the same brutal environment as everyone else. Low margins, high competition, rising costs. Yet somehow it avoids the fatal mistakes that destroy others. To understand why, we need to look at how UK retail usually collapses, and then look at how Spar quietly avoids every trap. Most UK retailers fail for the same reasons. They expand too fast. They lock themselves into expensive long-term leases. They borrow heavily to fund growth. When sales slow, the debt does not. This creates a deadly loop. Lower footfall means lower cash flow. Lower cash flow makes rent harder to pay. Debt repayments squeeze margins even further. Eventually, the business becomes insolvent. This is exactly what happened to many high street chains. They were profitable on paper but fragile underneath. Once interest rates rose, energy costs surged, and consumer spending weakened, collapse became inevitable. Now, compare that to Spar. Spar does not follow this model at all, and that difference starts with ownership. Chapter 2. The Spar Model. Spar is not a traditional supermarket chain. It does not own thousands of stores. It does not employ tens of thousands of store staff. It does not carry massive lease liabilities on its balance sheet. Instead, Spar operates as a partnership-based distribution model. Most Spar stores are independently owned. Local retailers own the buildings or leases. They take the operational risk. Spar provides the brand, the supply chain, and the buying power. This single decision changes everything about bankruptcy risk. When a Tesco or Sainsbury's store fails, the parent company absorbs the loss. When a Spar store struggles, it is isolated. There is no domino effect. Spar, the organization, does not collapse because one store fails, or even 50. This decentralization acts like a financial firewall. Most UK retailers collapse because their balance sheets are overloaded. Spar keeps its balance sheet light. That alone dramatically reduces bankruptcy risk. If you like this video, please subscribe to our channel. We want to hit 5,000 subscribers this week. Now let's move on with the video. Debt is the silent killer of retail. Retail margins are thin. Any disruption makes debt dangerous. Spar understands this better than most. Spar UK distribution companies do carry debt, but it is operational debt, not expansion debt. They borrow to move goods, not to speculate on property, not to fund massive store rollouts. There is a crucial difference here. Collapsed retailers borrowed against future growth. Spar borrows against existing demand. This means Spar has rarely been close to insolvency at a national level. There is no moment in modern UK history when Spar UK faced imminent bankruptcy. No emergency refinancing, no desperate rescue deals. Individual retailers have failed. But the system absorbs them. This is one of the most important lessons in retail survival. Spar does not try to be big, it tries to be resilient. Another reason UK retailers fail is location dependency. Large chains bet on high streets and shopping centres. When footfall dies, the business dies. Spar does the opposite. Spar thrives in places others ignore: rural villages, motorway service, residential neighborhoods, city outskirts. These locations are not dependent on fashion cycles or discretionary spending. People still need milk, bread, and essentials. This makes Spar defensive by design. Even during economic downturns, demand remains. When inflation rises, shoppers trade down. They shop locally, they reduce travel. Spar benefits. While large retailers suffer from declining basket sizes, Spar stores often see stable or rising footfall. This insulation from consumer volatility is critical. It means Spar is rarely pushed into survival mode. This is the uncomfortable question. Has Spar ever been close to collapse in the UK? The answer is nuanced. Spar as a system has never faced a UK-wide bankruptcy threat. There has been no moment where the brand itself was at risk of disappearing. However, regional distribution companies and individual retailers have struggled. Some have failed. Some have been absorbed. Some have exited the network. But this is by design. Failure is allowed to happen locally, so it does not happen nationally. This is the opposite of traditional retail thinking. Most chains hide problems until they explode. Spar lets weak links break early. This controlled failure is why Spar survives. Retail collapses that wipe out others entirely. So what does Spar do differently? First, it avoids centralized risk. Second, it avoids debt-fueled expansion. Third, it positions itself where demand is stable, not fashionable. But the most important difference is philosophical. Spar does not chase growth at any cost. UK retail collapses are almost always caused by ambition. Too many stores, too much debt, too much confidence. Spar grows slowly, cautiously, often opportunistically. It waits for others to fail, then moves into the gaps. That is not exciting, but it is survivable. Spar is not immune to pressure. Rising wages hurt. Energy costs hurt. Competition is intense. But pressure does not equal bankruptcy. Because bankruptcy is not about poor trading. It is about fragile structure, and Spar is structurally boring. That is its superpower. While UK retail giants gamble on scale, Spar bets on durability. While others build empires on debt, Spar builds networks on cash flow. That is why Spar survives every UK retail collapse. Not because it is smarter, but because it refuses to play the same dangerous game. In a sector obsessed with growth, Spar chooses survival. And in modern retail, survival is the hardest business strategy of all. If you like this video, please like and subscribe. We want to hit 5,000 subscribers this week. Thanks for watching. See you tomorrow.